Welcome to HouseLux Estate, your reliable source for insightful economic analysis. We're passionate about providing you with comprehensive and incisive content that helps you understand the intricate workings of the global economy. Our commitment is to make economics understandable, accessible, and interesting to everyone, regardless of their background. Today, we're turning our focus to an important and timely topic: 10 signs an economy is about to crush. We'll be exploring key indicators that can hint at an impending economic downturn. From rising unemployment rates to stock market volatility and falling house prices, we'll unmask these signs, explaining what they mean and why they matter. Our aim is to equip you with the knowledge to discern these warning signs and understand their implications. So whether you're an economist, a student, or just someone interested in the world of finance and economics, this is a discussion you won't want to miss. Stay tuned as we delve into these critical warning signs. The first sign of an impending economic crush is a rising unemployment rate. Now, why is that? Well, it's simple. When companies start to feel the pinch, they often resort to layoffs. This increases the number of people out of work, which in turn decreases spending. You see, people without jobs typically have less money to spend, and when people aren't spending, businesses aren't earning. It's a vicious cycle that can quickly spiral out of control. Moreover, a high unemployment rate means that more people are relying on government assistance, further straining public resources. It's like a domino effect. One piece falls and the rest follow suit. But here's the thing. The unemployment rate isn't just a number, it's a reflection of the health of our economy. It's a barometer that measures the economic climate. And when that barometer starts to rise, it's a clear indication that stormy weather lies ahead. So keep a watchful eye on the unemployment rate. Our second sign is heightened stock market volatility. Now, what does this mean? Imagine a roller coaster ride with its exhilarating ups and downs. That's the stock market when it's volatile. Prices of stocks swing wildly and unpredictably, indicating a lack of consensus among investors about the value of companies. Investors become unsure, and this uncertainty is a reflection of the broader economic environment. If the economy was stable, we would see more consistency in the stock market. But when there's volatility, it's a sign that something might be off. Why does this matter? Extreme fluctuations in the stock market can signal economic instability. Investors get nervous, they start pulling their money out, and this can lead to a domino effect throughout the economy. It's like a canary in a coal mine, warning us of potential danger ahead. So when you see the stock market acting like a wild roller coaster, pay attention. Remember, a volatile market often precedes economic downturns. Next up is a drop in consumer confidence. This seemingly abstract concept is actually a potent indicator of an economy's health. Consumer confidence gauges the degree to which people feel optimistic or pessimistic about the state of the economy. This sentiment, in turn, influences their spending habits. When consumers are confident, they're more likely to make purchases today, believing that their financial situation will remain stable or improve in the future. This spending fuels economic growth. But when consumer confidence drops, the opposite happens. People begin to tighten their purse strings, saving more and spending less. They may postpone major purchases like homes or cars, and even cut back on non-essentials. This pullback in spending can cause businesses to suffer, leading to layoffs, which further depresses consumer confidence in a vicious cycle. Therefore, a significant drop in consumer confidence can be a warning sign of an impending economic downturn. Consumer confidence reflects the health of the economy, so watch for any significant dips. Signs 4 and 5 are increased government debt and decreased industrial production. In the grand scheme of an economy's health, these two factors are vital indicators and can often hint at an impending economic downturn. Let's start with increased government debt. In its simplest form, government debt is the amount of money that a country's government owes. It's a double-edged sword. On one hand, debt is necessary for a government to invest in infrastructure, education, and health, which in turn stimulates economic growth. However, when this debt grows unchecked, it becomes a burden. An increase in government debt can lead to a decrease in investor confidence. It can also cause interest rates to rise as creditors demand higher returns for the increased risk, which can choke off economic growth. In the worst-case scenario, excessive government debt could even lead to default, which would have severe consequences for the global economy. Moving on to the fifth sign, decreased industrial production. Industrial production is a measure of output from the industrial sector, which includes manufacturing, mining, and utilities. This sector is a significant component of GDP and a vital source of jobs. A decrease in industrial production can be a red flag. It might indicate that businesses are cutting back on production due to decreased demand, which can be a sign of a weakening economy. It can also lead to job losses, which can further decrease demand and create a vicious cycle of economic decline. Furthermore, decreased industrial production can signal that a country is falling behind in technological advancements, which could affect its competitive standing on the global stage. In conclusion, increased government debt and decreased industrial production are two significant signs that an economy might be in trouble. Both factors can lead to a vicious cycle of economic decline that can be difficult to reverse. Therefore, keeping a close watch on these indicators can provide valuable insight into the future direction of an economy. These two factors often signal that an economy is heading for a downturn. High inflation rate and falling house prices are our sixth and seventh signs. These two indicators, when viewed together, can serve as a crystal ball revealing the potential for economic downturn. Inflation, as you may know, is the rate at which the general level of prices for goods and services is rising. In a healthy economy, a moderate amount of inflation is expected and even desirable. It's a sign that money is circulating, businesses are making profits, and consumers are spending. However, when inflation rates skyrocket, it's often a sign of imbalance. High inflation can erode purchasing power and create uncertainty in the market. As the value of money decreases, people are less able to afford goods and services, leading to a decrease in demand. This can cause businesses to lose revenue, potentially resulting in job cuts and further economic instability. Now let's turn our attention to the housing market. Falling house prices might sound like a good thing, especially for those looking to buy, but they're often a sign of economic troubles brewing. House prices tend to fall when there's a lack of demand in the market. This can be due to a variety of factors, such as high unemployment rates, decreased consumer confidence, or even an oversupply of properties. When house prices fall, homeowners may find themselves in a position where they owe more on their mortgage than their home is worth. This can lead to an increase in foreclosures, which can further depress house prices and lead to a vicious cycle. Moreover, the housing market plays a significant role in the economy. When it's suffering, the effects can spill over into other sectors. Construction companies may lose business, banks can face higher default rates, and consumers may cut back on spending due to decreased wealth. Both these factors, high inflation and falling house prices, can spell trouble for the economy. It's like a domino effect. One piece falls, and the rest follow. In the next scene, we'll discuss the final three signs of an impending economic crash. So, stay tuned. Our final signs are decreasing average income, falling GDP, and increasing bankruptcy rates. Let's start with decreasing average income. This is a clear indication of economic trouble. As companies grapple with falling profits and tighter budgets, they tend to cut back on wages or even lay off workers. This, in turn, leads to a decrease in the average income. People have less money to spend, and this can trigger a domino effect, leading to a decline in consumer spending, which is a key driver of economic growth. Next, we have a falling gross domestic product, or GDP. The GDP is the total value of everything produced in a country, and it's one of the most comprehensive indicators of economic health. When GDP is on a downward trend, it's a sign that the economy is contracting, not growing. This could be due to a variety of factors, from lower consumer spending to decreased business investment. It's like a report card for the country's economic performance, and a falling GDP is definitely a failing grade. Now let's talk about increasing bankruptcy rates. Bankruptcy is often a last resort for individuals and businesses drowning in debt. When bankruptcy rates are on the rise, it's a sign that people and businesses are struggling to pay their debts, which could be due to job loss, decreased income, or a sluggish economy. This can lead to a vicious cycle as businesses close, jobs are lost, and consumer spending decreases even further. In essence, these three signs, decreasing average income, falling GDP, and increasing bankruptcy rates, are interconnected. They feed off each other, creating a downward spiral that can lead to an economic crush. It's like a house of cards. Once one card falls, the rest follow suit. In a healthy economy, we would expect to see the exact opposite: rising incomes, growing GDP, and low bankruptcy rates. So when we see these signs flipping, it's a clear warning that trouble could be on the horizon. These are serious signs that the economy is in danger. To recap, we've discussed 10 signs that an economy is about to crush. We started with the rising unemployment rate, a harbinger of economic hardships. Then we explored the roller coaster ride of the stock market, marked by extreme volatility. We also talked about the drop in consumer confidence, reflecting the public's pessimism about the economy. We delved into the increased government debt and decreased industrial production, both indicative of a struggling economy. We also shed light on the high inflation rate and falling house prices, signaling economic instability. Lastly, we examined the decreasing average income, falling GDP, and increasing bankruptcy rates, all painting a bleak picture of the economy's health. Each sign, in isolation, might not spell doom, but together they could spell a potential economic crush. These signs are crucial for understanding the health of an economy and the possible challenges ahead. Remember to subscribe to HouseLux Estate for more insightful economic analysis. Thank you for watching.